Think Realty Nation, it's your host, Abhi Golhar. Welcome to the Think Realty podcast. You know what? I know you've missed me. So why wait? Let's go ahead and get this show started. A good one for you today. We're talking about Tampa, Florida, doing a little market recap there. And then we'll be interviewing Neal Bawa, who's the mad scientist of multifamily. So for all of you multifamily wannabe investors and even those multifamily investors that are doing a lot of capital raising right now, this is going to be a fantastic, intense 15-minute conversation for y'all. Then we'll talk about, is cold really the new hot for real estate investing? And finally, capping off the show with one very important concept: 3 kinds of cash you need to build an empire. That's what's lined up for the Think Realty podcast for today. Let's get started. This podcast is brought to you by Roofstock. If you're ready to buy your next investment property, then check out Roofstock, the #1 marketplace for buying and selling single-family rental homes. Featuring tenant-occupied rental properties for sale in over 20 states, Roofstock makes it easy to invest in cash-flowing real estate outside your local market. And to help you invest remotely with confidence, all properties are backed by Roofstock's industry-leading 30-day money-back guarantee. Sign up for free today to find your next cash-flowing rental property at roofstock.com/thinkrealty. Tampa, Florida, one of the few cities in Florida that I haven't really visited, seems to be on everybody's radar. Just like Jacksonville or Orlando. Miami, not so much. Miami isn't really on my radar unless I want to go to the beach and have a little Mai Tai. But Jacksonville, Tampa, Orlando, Gainesville, Florida as well, all on my radar. Why is Tampa on my radar? Well, we've got a metro population of about 3.1 million people, median household income right around $65,000 a year, unemployment rate at 3.4%, median home price at $120,000, and monthly rent right at about $1,100, just $25 shy of that, actually, to be completely honest. What's the real reason why I should be investing in Tampa? Well, it seems that prices are still a little low. It's got a strong local economy, it's got a rapid population growth, and a major focus on job creation, especially in financial services, STEM, and healthcare. These are really important industries, and actually healthcare and the professional services industries are the first 2 industries to generally recover after any type of recession. So it's always a really good thing. And buy and hold right here makes sense, especially for the small multifamily. Got questions? Get in touch. Go to thinkrealty.com. And you know what? Discover Tampa. You might just find yourself a little gold gem of an investment. Next up is Neal Bawa, again, the mad scientist of multifamily. You're about to find out why right now. Mr. Neal Bawa, welcome to the show. How are you doing, man? Good to see you.
Fantastic. I'm really thankful for you to bring me onto the show.
Hey, it's my pleasure. You are the mad scientist of multifamily, and I have already prepped some of the viewers and listeners of this podcast that we're going to have a mad scientist that's going to be jumping on in a second, and I think you fit that mold, right? You've got the hair. It's great. I mean, when I think of Neal, I think of numbers, I think of crazy analytics that I would have never thought of before. And every time I listen to one of your presentations or anytime I see a post of yours on LinkedIn or Facebook or Instagram, whatever it is, I'm always reading it and I'm always paying attention because there's something there. And I know you would have selected that article to post for a reason. And, as mad scientists do, right? There's always some reason behind the chaos and behind the madness. So, Neal, do me a favor. I know you really well, and we're good friends. But for those of us listening or watching that don't know who you are, give us a little background on who you are and what you do.
Sure. So I'm a technologist, successful tech career, successful tech exit. I got into real estate in reverse. Most people start with a single family rental. I started with a $4 million project, a 27,000 square foot campus. My boss didn't want to be a tenant anymore, so we decided to build our own campus for our non-real estate technology company. And that was 2003. And for a year, basically, I didn't get any sleep. I slept maybe 6 hours for a year because all I was doing all day long, let's turn that off, was basically doing my day job until 6 p.m. and then from then onwards until 2 or 3 in the morning until I would just, fall asleep at my desk from exhaustion. all I was doing is basically building this campus. And 11 months later, it was done, and I'd learned an incredible amount about real estate. Repeated that with a bigger campus 2 years later, and that really got me kickstarted in real estate. And then did the whole single family, bought 10 in California, still own them, went up to triplexes in Chicago, horrible investment, and learned a lot there. And then basically became a passive investor into multifamily, did 13 passive investments, learned from all the syndicators, became friends with them, gave them my digital marketing tips for tenant marketing, and then basically after selling my technology business, transitioned into real estate full-time. Now I have 1,200 investors, portfolio that's 150 million or 180 million, depending upon how you measure it, and properties in 9 states, mostly multifamily, but also some student housing. So that's,
congratulations
in
on the
2 minutes
success.
is my story.
That's awesome. You use a lot of science, you use a lot of data science to target some of the best markets in the United States. And that for me is really cool because it's not just, hey, let me like spin the globe, or in this case, let's get a chart or let's get a map of the United States, unfold it and like blindly start like pinpointing cities we want to go to. You use data science. So help me understand, A, where do you get this data? B, how do you analyze it and how do you manipulate it so you can actually create actionable intel based on what you have available?
Makes sense. So first, to start with, why data science? So one of the key things that I love telling people is that we live in an age where information and analytics and data is the oil. Right? So if you look at, this is the oil of the 21st century. And if you're not using data on a regular basis and making investment decisions, you're not an investor at all. You should remove the word investor and replace it with the word speculator. Right? And I believe that over 99% of the real estate investors in America are real estate speculators. Right? So they're listening to their gut feel, or they're listening based on what somebody said at last night's meetup, or what their friend said a month ago about an awesome guy in some place.
Right.
That's not data, right? When you're looking at data, your job is to basically look at what's out there, measure it, right? One phrase that I love to talk about is, if you cannot measure, you cannot manage. And most of the time, we're not measuring, right? And you measure both before you buy a property and after you buy a property. So most of my seminars and webinars, podcasts on the web are about how do I find the best cities and neighborhoods in America to invest in. Yeah, I wish there were more podcasters even also asking me about, okay, so what happens after you buy a property? What do you do with the data after you buy one? And I think that story is even more compelling for those of us that are really in the business. But for the rest of you that may just want to buy a single family property or maybe a 2-unit, here's the answer to Abhi's question, right? The first question he basically said is, where do you get the data? Well, there are 4 main sources that I want to give you in this short podcast. Number 1, Google, right? Population data is from Google. Any city, type in population space, name of the city, and Google will give you a wonderful graph. If that graph is moving upwards at more than 1%, 1.25% population growth every year, if it's moving upwards, then you're in the right city. If it's flat or if it's down, then you're in the wrong city. Up, Columbus, 1.4% population growth. Columbus, Ohio, Rust Belt city. Flat, Cincinnati, Ohio. Down, Dalton, Ohio. So I picked 3 cities from Ohio because a lot of times people want cash flow, and for cash flow, you basically have to go to a lot of the Rust Belt cities. So I picked 3 in the same state to show you how much of a difference there is. The money that you make in Columbus on a 10-year hold is probably going to be 2 times what you make in Cincinnati and probably 3 times what you make in Dalton. So it doesn't make sense to go to Dalton, even if the cash flow is higher. Right? Because on the front end, we all want cash flow, but we know in our gut that appreciation on a long-term hold is king, not cash flow, right? Cash flow is what we need today to run our life, our business. But you've got to be careful about where you go. So number 1 tool, Google for population. Number 2, for the other 3 or 4 pieces of data that I'm going to give you today is city-data.com. Remember, there's a dash in the middle, city-data.com. This site is wonderful. If I plug in the word Columbus in there, scroll down just a little bit, it's going to show me, firstly, it's going to show me what was the median household income increase in Columbus. Median household income doesn't matter. San Francisco Bay Area might be $100,000. Columbus might be, right now, I think it's about $40-some thousand. What matters is change over time. You're measuring how a city is going up. And what you want for median household income is for a roughly 1.5% change in income minimum to happen over time, right? And when you don't see that change, you're losing to inflation. And it's right there. It's going to give you an older number. I think it's the year 2000. It's going to give you the newest number it has. Just look at the two numbers, do very basic math, and see if there's a 1.5% difference. Columbus, right around 1.5%, so a little bit more than 1.5%. Can I say that for Cincinnati and Dayton? Unfortunately, I can't, right? Yeah. So that's my second number, and it's also on that city data website. And right below that, the next line on city-data.com for any city in America is how home prices, right? So median household or condo value, that's the actual name of it. But basically, they're talking about home prices. Once again, it's going to give you two numbers on the same line. Well, what you have to do is to make sure that the two numbers are now 2% every year, right? So I'm giving you a progression here. 1.25% population growth, 1.5% income growth leads to 2% home price growth. And a lot of cities obviously beat that these days. You know, you get 3, 4, 5% home price growth. Mm-hmm. But remember, that data is over 15 years. Why? Because if you're going to have a boom time like the last 7 years, you've got to take a bust time like 2008 to 11. You've got to put that in as well, right? So, well, those two numbers have the boom and the bust both in there. So now you can see which cities are actually growing, right? Everything goes down in a bust, everything goes up in a boom. But when you start looking at 15 or 20 years of data, you can tell which cities are going up and which cities are going down.
And you,
so once again,
bake
Columbus
that in.
is 2%.
Exactly. You can pretty much bake that into those numbers is what you're saying, and it will normalize.
Exactly.
Instead of only
it normalizes everything, right? Yeah. Over a 15, 16-year time frame.
That's right.
And so that's why those two numbers on the city data website are going to allow you to look at a place like Columbus and say, I want to invest there, right?
Yeah.
Or some of the other great markets in the U.S., Phoenix, Orlando, Tucson, Boise, Idaho, Coeur d'Alene, Idaho, Fort Myers, Florida. These are all incredible markets. And the one thing you'll find is that all of these markets are not just in the top list for jobs, they're also in the top list for these numbers, right? Mm-hmm. They do really, really well on these numbers. But then there's so many cities in the U.S. that don't do well on these numbers. And if you're truly data-driven, you have to accept that. You can't say, my brother-in-law lives in XYZ city, and even though Neal's numbers didn't match up, he says that it's a great place to invest, so I'm going to invest.
So I love that. I even love the analogy of like doctors trading stock tips, right? Like that happens all the time. There's no due diligence, but because Dr. Bozo tells Dr. Genius that, well, hey, you should invest in this thing. That's why they invest. It just doesn't make any sense. There's no data driven behind it. And that presents a problem. So you have this data, you have this structure. The first thing you mentioned was Google. Second thing was city data. We're looking at the three things. What are number 3 and number 4?
So on the same city data page, scroll down and there's a crime graph, right? So there's a big table that shows the crime in the city. Scroll to the last line. It's blue in color, right? Make sure the number on the right is 500, okay? That number should be 500 or lower, and crime should be declining. That last line is the history of crime in that city, and you can see everything from 2002 to now. And make sure, number 1, crime's declining, and number 2, it's lower than 500. So if you pick that number up, you know that you're not going into a crime-infested city. Doesn't mean that it doesn't have crime. All cities have crime, and high-density areas, apartments, tend to have more crime than low-density areas with single-family homes. That's not a big deal. What's important is you want to be in a city where crime is declining consistently, smoothly over the last 15 years. Why? Because if you want to hold for 10 years, you want that number to decline by another 100. Maybe if it's 500 now, when you leave, it's 400. Guess what? Crime rate declines are the single biggest indicator of home price increases. So in 10 years, you're going to win big simply because crime is going to keep declining and everybody wants to buy in an area where crime is declining. So now what you're doing is you're gaming the system the way that the institutionals are doing. Blackstone, the $2 billion company, when they're buying, they're using these same numbers that you're using. So what you're getting is an all ships rising effect, where every institutional is buying using the same numbers that you're buying. So even if the place was not as good when you started, it becomes better as time goes because all the top guys are investing in it, right?
Yeah.
So that's the next number. You've got to make sure that the crime numbers are great.
Yeah. And what's number 4?
So the next number is not on this website. It is on a website called departmentofnumbers.com. And I'll plug that in for you guys so everybody gets access to it. But it's DEPT of numbers.com /employment/metros. I know this one's hard. DEPT of numbers.com /employment/metros.
Yeah.
This is the job numbers for the last 12 months for every city in America, right?
Yep.
Simply sort it by the last 12 months. And please, for God's sake, don't invest in cities that have negative job flow, because you cannot possibly make any money, even if you're getting stuff for free, right? So do not buy there.
So what's interesting is St. Louis very recently said, well, hey, we'll give away homes for $1. And
no.
Yeah, right. This is why you're the mad scientist. You even look like it, right? You're like, oh no, don't do this. Yeah, it's such a bad idea. I just don't understand.
But basically what's happening is they're trying to, so the moment you get those free homes, right, now you're responsible for the repair. Most of the time you have to demolish the home. And if you don't demolish it, you're going to pay real estate taxes that are going to go up every year.
Yeah.
So you're going to be trapped in there forever. You can't exit that home and give it away for free to somebody else, right?
That's right.
You're stuck in there forever, and they're charging you real estate taxes for the next 20 or 30 years.
That's right.
That's
and even
the worst
if you lost track of time and you forgot to hit your milestones, the city gets the property back. So you're out of luck. And that's a problem.
And worse, most of the time they won't take it back. They'll keep fining you and basically raising your legal costs. Remember, if the city sends you a warrant, you can't ignore it. You're going to get in trouble, right?
Yeah.
So what you have to do is basically show up in that city with an expensive lawyer to basically tell the city why it is that you're not able to pay your property taxes. So that's really the worst stuff that you can do. What you can do that really games the returns for you is on this page, on this jobs page. Here's the rule of thumb. 2% employment growth in the last 12 months is good. 3% employment is I am super happy. 4% is I'm buying, basically truckloads of champagne. 5% is I'm doing the naked dance on the street on Saturdays, right? Of course, and with the champagne bottle, right? So for me, I only do naked dances on the weekend. So
you're right, because you're the mad scientist. I get that.
2, 3, 4 at that 5%. 4 is still phenomenal, by the way. When you invest in a city that's 4%, everything goes up, because guess what happens in a city that's higher than 3% job growth? Everybody wants to buy everything in sight.
That's right.
Right? So you can basically go buy and fix and flip. And by the time you finish your flip, the value of that property is increased even if you did nothing to it.
So it seems to me like this is
possible to do a flip in one of these markets that's at 4%, and don't do anything to the property. Just hold it for 90 days and sell it, right? And make money. Because the 4% job market makes everybody in the city go slightly loopy, right?
Yeah.
So I may be the mad scientist, but these people go a little bit madder than me.
So you're the mad scientist and you're prescribing them to go see a psychiatrist. So that those are totally, all right. So I had a bunch of notes here. Like, look, I had all the notes in the whole wide world. And we're supposed to talk about, the upcoming recession and all this stuff. We've run out of time. We are clear out of time. So let's do this. We'll have you back. I think it'll be a really good opportunity to have you back, and we'll talk about this potential recessionary environment and all the nonsense that's being said in media.
I have some controversial views. I'm warning the viewers.
No, it's good. So let's talk about it. I want to get in touch. What's the best way to do it, Neal?
So it's our website. So we have a portal where 30,000 people a year attend webinars, deep dive webinars and content. It's multifamilyu.com. That's multifamily followed by the letter u.com. And if you want to get in touch with me personally, it's Neal, Neal, that's the Irish spelling, Neal at multifamilyu.com. So feel free to reach out to me, and I'd love to chat with you.
Awesome. Think Realty Nation. It's the mad scientist himself. Neal, thank you so much. I appreciate the time.
Thanks so much, Abhi.
You got it. All right. We're coming right back. Stay tuned. This segment is brought to you by Narada Real Estate Investments, your premier source for cash flow investment property. Visit www.turnkeyrealestateinvestments.com. CNBC said coal is the hottest new real estate investment. I'm not sure if they're talking about ice or maybe investing in somewhere on the south or north poles. I highly doubt that's the case, but it seems is that cold storage warehouses and distribution centers are suddenly in high demand, and that's thanks to new food delivery services like Peapod by Giant, Amazon Fresh, and Blue Apron. It's a very niche market. About 2 or 3% of all goods and groceries are bought online, and we expect the space could explode to 13% over the next 5 years because of penetration on the internet. And I mean, you take a look at even your chef delivery service. I think Tasty's getting involved. So this seems like a pretty interesting opportunity for real estate investors to take a look at, especially maybe as some of the hotter real estate investments start to kind of cool off. No pun intended. So kind of interesting. Cold may be the next hottest new real estate investment. Now, I was actually thinking about this in terms of also markets. All right, where cold is the new hottest real estate market, it could actually make a lot of sense. I live in Atlanta, so I may not want to only look in Atlanta right now for opportunities, but maybe I want to look outside Atlanta, maybe like 2 or 3 hours, maybe in a different state, maybe in a market that's a little colder. You tracking me on this? All right, get in touch. Got some questions? Go to thinkrealty.com. Next up, the 3 kinds of cash that you need to build your kingdom. Build your kingdom. This is actually it's an article written under the Money Matters category on thinkrealty.com, written by Deborah Razzo. She was a guest on the Think Realty radio show, and I think we've also had her as well on the Think Realty podcast. So there are 3 types of cash that you need to build a kingdom, a mountain of cash. The first is cash now. You need cash now to pay the money, to pay the rent, use this money to pay the rent, pay the bills, pay the phone bill. That's why you need cash now. You need cash monthly. Of course, we're talking about cash flow here. And this you can use to stream up into different types of investments. You got these larger checks coming in. Maybe these large checks represent flipping profits. So monthly cash flow from this perspective, and then cash later. Your longer term real estate investing opportunities that are going to give you cash later that you're not going to capitalize on right now, but they have a positive net impact to your bottom line. Cash now, cash later, cash monthly. The 3 types of cash you need to build a kingdom. This podcast is brought to you by Roofstock. If you're ready to buy your next investment property, then check out Roofstock, the #1 marketplace for buying and selling single-family rental homes. Featuring tenant-occupied rental properties for sale in over 20 states, Roofstock makes it easy to invest in cash-flowing real estate outside your local market. And to help you invest remotely with confidence, all properties are backed by Roofstock's industry-leading 30-day money-back guarantee. Sign up for free today to find your next cash-flowing rental property at roofstock.com/thinkrealty. Hope you had a good time listening in and watching the show today. Have questions, get in touch. Go to thinkrealty.com. We're here for you. We are your resource center. If you want an intro to anybody on the show that I've interviewed, simply shoot me a message anywhere online. Think Realty Nation. Until next time, happy investing.